For more on the markets and earnings season, let's bring in Gabriela Santos. She is global market strategist at JPMorgan Asset Management. Good to see you. Recession, we're just talking about how it affects people. So you think that the chance of a soft landing has increased, chances have increased, but it's not clear sailing. We still don't know.
I do think you have to say that the odds of a soft landing have gone up. I mean, we've gotten so much information the past 2 weeks on both sides of the Fed's mandate. On the job side, we have had much more resilient jobs data than we expected. It really is normalizing instead of decelerating as we had expected, and that keeps incomes growing, it keeps consumption moving. And then lastly, last week we got the other side of the mandate with a broadening out in disinflation trends, and that just lessens the odd we'll get some kind of Fed-induced recession later this year into next year. Doesn't mean we're done with that debate, unfortunately. I think all of us are sick and tired of having that conversation, but I think later in the fall, perhaps it comes back a little bit, because we'll continue having a conversation about how much is consumption normalizing versus something more nefarious. How much is business hiring normalizing versus businesses batching down the hatches? So I do think in the fall this conversation comes back. And of course, with regards to the Fed, Jackson Hole, the September meeting, will be important markers to see if we're right about this expectation of just one more hike and then we're done. Even though you think one more hike, but then we don't go to zero on future hikes, so we'll still be talking about it. But you say that that we're starting to shift the emphasis to cuts again, and that you don't think it's crazy to think there could be cuts in the first quarter of next year. That doesn't sound like a soft landing. Why would you cut if we had a soft landing? I think the conversation after the CPI report last week is around this consensus of just one more hike. And now the really investor attention is coming back to when we'll start to see rates normalizing. When will we see the first cut, and how much will we get in 2024 and 2025? The exact timing will depend, of course, on the actual data itself. But I think it's reasonable expectations are now for a first cut in March.
Why a cut? And the Fed thinks normalizing is going up. You're saying normalizing is at lower levels than we are right now?
Well, I think we have to remember that the Fed's own estimate of neutral, right, neither accelerating or breaking the economy is 2.5. We're double that. And that's the nominal rate. As inflation comes down, your real rate actually increases. So it becomes more restrictive, even if the Fed does absolutely nothing. Right. So even if we don't get a hard landing, we have a soft landing, 5.5% rates are just way too high for this economy.
You don't think the labor is going to be sticky? The labor component, service component, travel, all that might be sticky. We may not get below 3 or wherever we are right now.
On inflation?
It might be harder.
So I think not this year. We got the big leg down in June because of the base effect. So for Chair Powell's super core, we got that big move down from 5% in May to 3.6% in June, and we'll probably stay in those low to mid threes for the rest of the year. And then next year, we have confidence that it comes down further to 2%, and then the Fed can feel like forward-looking indicators are moving us in the right direction. And what I think is most important for fixed income, the sale has been extended to capture these 15-year high yields and benefit from future drops in yields or price appreciation. Mm-hmm. So the risk reward for fixed income is very attractive. Starting right now, we could be talking about double-digit total returns.
Longer duration fixed income.
And I don't think you have to go from money markets, where we see a lot of money right now, to 30-year bonds, right? Just neutral duration, which would be something in the intermediate part of the curve, 5 years, 6 years, is already quite good. And if yields fall just 1% from here on the curve, you could be talking about an 11% total return in the U.S. aggregate.
Right.
So the risk reward is very, very interesting, but we have to capture the yields where they are now before they normalize.
We have only had a handful of earnings so far. Can you glean anything from what the rest are going to be like? What kind of surprises could we see? Would they be good surprises or bad surprises?
So very early on, it's been interesting. So the first quarter expectations going into the earnings season had come down way more than normal. So the bar was pretty low. And we still didn't see beats be rewarded very much, even though we did have higher beats on earnings and revenues. This quarter, expectations haven't come down as much. Actually, not as much as is normal, the 5-year, 10-year average. So expectations are a bit higher. So it's going to be really interesting to see what kind of beats we get, but also whether they start being rewarded again. And we'll especially within the earnings picture on a more macro level be focusing on margins, right? How much can companies still increase costs to their end consumer above and beyond what their input costs are still increasing if we think about wages and we think about interest costs?